Uh, well, before I go across to Mayuresh, let me quickly start taking up the first one, and we have Tata Motors right at the top. Now, while its consolidated revenues were largely in expected lines, of course, we saw a sharp drop of around 28%. Its net loss figure is much larger than expectations, so coming in at just shy of the 10,000 crore mark. But the company's taken a lot of provisions, and the company is also, provided for certain other, exceptional losses, which is why we're looking at a loss of around 9,800 crores as against with the expected loss of around, 1,100, 1,300 crores. But let me get in Mayuresh Joshi into the conversation. Mayuresh, good morning. Your view on Tata Motors? I know it's a sum of many parts, because Jaguar Land Rover is one of the more important ones. But how would you approach Tata Motors from here on?
Morning, Agam. So as you rightly pointed out, I think the loss figure much wider and much larger than what a lot of people on the street anticipated. And I think 2-3 broad reasons for the entire loss aspects. Yes, obviously there were some exceptional items that play as well. But the volume degrowth that we were all expecting, both in terms of the JLR business as well as the standalone Indian business entity, the volumes have degrown quite significantly. The second element, obviously, in terms of pricing pressures, has clearly played out right from the top line right till the bottom line as well. The margin compression because of all these factors was very, very evident. So JLR margins of 4.8 odd percent had a massive 550 points dip. However, I think if you look at the positives in terms of what the stock can probably exhibit going forward, and the large expectation is that Q1 is still expected to remain very, very soft, as it's going to be a very, very slow and gradual recovery for the industry as a whole, whether it's the Indian markets, the European markets, or the North American markets. Therefore, I think the kind of free cash flows that JLR managed to post, specifically in Q4, when the Indian business was having a negative operating leverage, I think that mixed bag clearly played out on bottom line. The second element, obviously, is that the finance costs have remained elevated. So they've increased 1,500 odd crores to 7,250 odd crores during the entire financial year because of the higher gross borrowings that they had to go. Because of all these factors, the free cash flows continue to remain at 9,200 odd crores. And that itself is a little bit of a worrying sign. And therefore, they've cut their capex by 1/3. So the overall capex actually comes down significantly to support cash flows going forward. China is the only bright spot that I've probably seen the last 2 months. With China opening up, the recovery in China has been quite reasonable. So in April, they put out the press release, 6,900 odd vehicles is what they've sold. And in May, almost close to 8,100 odd vehicles. So it's a mixed bag. I think it will take time to recover. The earnings are very, very patchy at this point of time and expected to remain so. Therefore, I think our methodology as per William O'Neill and Cancelman, we look at it, I think the earnings are expected to remain extremely, extremely soft. And therefore, I think the price movement might just be exhibiting a range-bound move, because I think the worst is probably there in the price. The expectation now will be on how they'll be doing their deliverables in the next few quarters as well. So price-bound move, but again, I think as per our methodology, I think this stock will still exhibit weak earnings, and therefore I think we'll have to wait and watch.
Okay. Well, the next topic we want to talk about was oil marketing companies. And as we speak, in fact, right now we have some breaking news where petrol prices have been hiked by around 50 paise and to around 76.7, and this is in Delhi. And diesel prices have also been hiked by around nearly 60 paise to around 75.2. Again, this is in Delhi. No, there's been no respite for fuel prices, Mayuresh, and we actually did want to address oil marketing companies because, of course, we're expecting earnings from HPCL as well. But what's your view on the entire pack? How would you address this sector?
So if you clearly look at the structure for oil marketing companies, two broad variables which obviously have a huge impact from an earnings perspective is the pricing of crude and how the rupee dollar movement itself is. Now, the first element that you put forth, even when oil prices had dipped, the kind of increases that we probably saw, both in terms of the excise duty hikes that were taken in and mandated from the center itself. The marketing margins to a large extent got protected. So if you see around 70% Agam of the retail price of fuel companies, whether you account that for excise duties, VAT, cess, the current spike can be attributed to the increase in duties which have already taken place. 10 rupees a litre on petrol, 13 rupees on diesel as well, which happened last month. So I think the gradual increase was given. The second element, obviously, is the expectations in terms of how Brent pricing will be. So if one largely presumes Brent to move in the range of 35 to 45 or 40 to 50 with the base case scenario of 40 to 45, I think the kind of earnings that they can still post, specifically on the marketing front, which becomes a huge element for these players, I think that part of business is protected because of the hikes and the margin protection that they have taken. Though I think to reach their peak levels, it's still $5 to $6 away from the current level that we are seeing. The third element, obviously, is the refining part of their business. And the refining part obviously depends in terms of where the crude pricing is, how the processing is expected to happen going forward as well. And quite a few of these facilities have good complexities in terms of processing crude. So if you leave aside this quarter where there is the adventitious inventory loss which will come through, I think the built-up in terms of the inventory is at lower levels, and the expectations of processing that as well as the economies have opened up, both in terms of retail as well as ATF in terms of aviation fuel that they cater to. I think that can be a positive sign when it comes to the volume growth. And the third element, obviously, is valuations. Valuations obviously have become very, very cheap, assuming both these conditions playing out, and the presumption that the rupee against the dollar expected to gyrate around 73 to 75. So to a large extent, I think the hit in terms of the currency translationary impact will also be largely gestated in Q4 numbers. So valuations cheap, cash flows are expected to remain a little bit soft. The investments that they carry on their book and the dividend yields that they generate, I think that is something that still holds these companies out. But again, I think, as I said, these companies attractive on a valuation basis, on a price to book basis. But from a business perspective, I think there are too many variables to play out for MC companies at this point.
Okay, fair enough. And let's talk about the final stock then we want to talk about. And that's Shriram Transport Finance. From what we understand, the news, of course, this morning is that the board has approved raising of around 1,500 crores via rights issue and another 2,500 crores via specified securities issuance. That said, Mayuresh, we had earnings from this company as well a week or two ago, and we had mixed reactions. But again, I would suggest that the reactions weren't as negative to the earnings as one might expect. How are you placed on Shriram Transport Finance?
So I think, again, a very tricky space looking at how the economic conditions are getting played out. They've offered 95% moratorium to its customers. The only silver lining or the positive sign that I see from a company's perspective is that the line of business that they're probably into. So if you probably look at their business segments itself, the refinancing or the truck refinancing segment, which is still a majority of their lending and the disbursement business, that should start holding up compared to the new truck financing as well. Though they have forayed into that part of the business, the used CVs in their con call is something that they clearly played out, that a lot of inquiries were getting played out. The second element from an NBFC and even a Shriram Transport Finance perspective is the borrowing mix that they've got. And they've largely transitioned in their borrowing mix in terms of ECB borrowings, NCDs. Therefore, the dependency on a single part of paper or line of paper is probably getting away in terms of the diversification that they've done. From a liquidity perspective and the raising of money that you're probably talking about, they did mention in their con call that there are enough obligations or liquidity to meet obligations till September 20. But to carry on balance sheet growth, I think they would need a sufficient amount of capital going forward, and therefore the need of a similar capital raise expected or probably expected to come through. On core parameters, GNPAs for the quarter gone by at 8.4 on a gross scale. On the net NPA scale, 5.8%. PCR at 35 odd percent. When you probably talk about how the entire credit cost has panned out, even if you probably assume 2.5% on an annualized basis, it spreads getting curtailed to around 7 odd percent. I think there is some amount of steam that can get generated if the management, as it's speaking about, gets translated from the inquiries into actual disbursements. and NIMs actually getting maintained at that 7% level with no significant spike above that 2.5% for credit costs and a corresponding increase in the provisioning as well. So I think the next quarter's numbers are going to be interesting. The capital raise obviously accretive to the book and maybe an element in terms of short covering for the stock on the presumption of these news coming.
Sure. Well, Mayuresh, we'll leave it at that. Thank you so much for joining us and taking us through
Thank you so much.
We spoke about.